Rewind that and watch that again. Hi guys, it's Sunday morning, first of the month, and the mortgage has been paid. How good does that feel? It's nice, and another month down. For me, it's another 336 months to go because I have about 28 years left on my mortgage.
Wow, I thought you'd be a little more shocked.
It's a really common question that comes up and one I really wanted to chat about, so I covered it in my cringe binge days, and those are the days when I first started YouTube and I was horrible at it.
Chandler!
Oh my God!
Back then it felt odd that I was making overpayments of a few £1,000s a year, and it really felt like I was missing out on the opportunities of investing. It just didn't feel right. I had even adopted the FIRE mindset, and that meant I should be aggressively investing to live that financially free life. It just didn't feel like I was investing enough if I was focusing on clearing that mortgage debt. Though this month it's different. My mortgage is now about £70 cheaper a month, leaving extra in my budget, and because I have become so accustomed to overpaying, I wanted to know if I should keep paying that as nominal a number as it is, or whether I should invest it. If I overpay £70 a month, that's about £840 a year, and it's not really a dent in my Hackney home, even after 28 years or whatever it is.
I love it when we share.
So what I want to talk about is, before you consider overpaying on your mortgage, there are 3 essentials we need to get accustomed to. I consider these as the very basics that you should have in personal finance. Once we have these 3 components sorted, we can really look at the pros and cons of whether we should pay off our mortgage. So let's jump into them. Firstly, a fully funded emergency fund. This should include the amount to cover your living expenses. So it includes your mortgage as well. If things really hit the proverbial fan, that is, you can ride that wave of not being employed and cover the cost of the mortgage. Secondly, no high interest debt whatsoever. You really can't contemplate paying off your mortgage if you're servicing credit card debt of like 15 to 25% when mortgage debt is only a few percentage points. It's kind of daft to strive to pay off your mortgage if you're suffering interest in those debts elsewhere. So they're the first priority. And then the third one, at a bare minimum, absolute minimum, you should have 15% of your income going into retirement savings. I love that squirreling away analogy. Guys, I didn't really think about this until now, but at the end of last spring, the squirrels were digging up the garden to squirrel their nuts. And now they're back and doing some digging again. I wasn't sure if they were digging up or squirreling away, but lo and behold, I saw the carcasses of empty monkey nuts in the middle of my lawn over the weekend. Anyway, the point is, we need to be squirrels, but I diverge. Now I've got those 3 things sorted. What I really wanted to look at is whether I should overpay on my mortgage. In my situation is I have a positive net worth, and that is, if I sell everything off and pay down all my debt, then I'll have cash in the bank. So on paper, I could pay off my mortgage effectively whenever I want. But practically, I'll have no real estate asset. As dreamy as it sounds, I'll be busking like Tracy Chapman belting out Fast Cars. I love that song on probably Hackney Central Station. However, and I'm not gonna lie, it's a nice feeling to have a positive net worth as a homeowner. It's comforting. So check it and let me know how it feels. Now I'm going to talk about a very powerful statement. When you overpay on your mortgage, you are essentially putting money into a savings account where your mortgage rate is the savings interest rate. Though the main bugbear is, while you get quite a low rate, you don't get any of the benefits of a savings account itself. You can't just take the money out if you need it. So of all the investing options for a longer period of time, it's the worst rate of return you can get. The main benefit, of course, is not economic. It's the comfort, joy, and even peace of owning your own roof and having that roof over your head. From a pure investing point of view though, the return profile does not marry the time horizon. The longer we leave money invested, the more we can strive for returns from riskier assets like equities. Let me preach that shizzle again, guys. The longer we invest, the less riskier the stock market becomes. That in a nutshell. You're welcome. I wanted to throw in an example and make sense of this so I could really visualize the numbers. So as an example, with a 600k mortgage and an interest rate of 1.65%, which is actually my interest rate, comparatively, I think that's quite a good rate. So the easy calculation, if I don't overpay that £70 a month and invest it every month in the stock market for 28 years instead, getting that historical rate of 10% every year in the US market, then at the end of the 28 years, when I'm an old granny, I would have 128k sitting in the bank, guys. And that would have been through total deposits of something like £23,500. I would have 5-folded my money. That's pretty cool. Now, there is a big but here because mortgage rates will go up and down over 28 years, but just on the current rate of 1.65%, and that's the rate I have actually at the moment, I would have made £29,870, so about 6k profit. Rewind that and watch that again, and that is, I would have fivefolded my money, and that is pretty cool. So 128k versus 6k, I really wonder which one I should take.
I had a very hard time believing this was true.
But for me, if I overpaid my mortgage by £70 a month, it would reduce it by 2 years, roughly. So instead of 28 years, I'll clear it in 26. Get the party poppers out, guys. So I guess we've come full circle. What I've relearned hasn't really changed my opinion much, and that is the longer your mortgage, the more attractive investing becomes. And that is because of two main reasons. First, the wonder of compounding, and secondly, investing in the market becomes less risky. If you do have a shorter time horizon, then yes, I can see the point of just getting rid of that mortgage baby. But really, just in my example of £70 a month, it's just ludicrous for me to pay extra to my mortgage.
Don't read anything. If you don't read it, it can't harm you.
And in cases like these, mortgage debt can be a good thing. It can be a powerful tool to leverage our returns, and I feel much happier having run through this again with you guys actually. I'll keep paying the same amount to the old ball and chain of a mortgage. Now, there are two videos that go hand in hand in actually understanding the power of leverage and also compounding and how that works. These two together are really a match made in heaven. It also makes sense to have a simple grasp of passive equity investing. So I've put these videos right here. I hope I'm pointing in the right direction this time. And I'll see you over there.
Get out of here. That's the most persistent fly I've ever seen. Nice.